your thoughts on the data out of China? Is that enough to support the markets?
Well, not quite yet. I mean, I don't think the data was that bad, actually, but I think the bigger story is here with a view to next year. China, as we all know and we all heard just now, has been, rather tight in terms of its macro policy this year. I think they did that well in the sense that they did the painful front-loading of stuff they wanted to do in the long term in a year that saw very strong growth overseas. US GDP in nominal terms is growing at a 10% pace. Europe is doing well too, coming out of the lockdown. Next year, that's going to change. The world is going to be slowing down to a more normal pace, and I think that's when China will start to ease, and that's when you will really see it in the data. So the current data is kind of okay-ish, but we're not there yet. But I think the situation is constructive enough to look forward to what's going to happen next year, and the market has actually started to price that in a little bit.
Yeah, so would you be recommending some dip buying in China right now?
Selectively, perhaps, yes. That's not our approach, but I would say that especially in the tech sector, for example, the worst may be over, tentatively at least, if you think about where tech stocks have gone in the West, in the US in particular, compared to there's been such a big gap for a reason, but that may be priced in by now. So good companies will always have growth. You could even argue that some of the measures are good from an ESG perspective. Like keeping kids from playing too much video games may not be such a bad thing. Painful, although it may be in terms of earnings right now. So I think definitely selectively you can look into China.
You're still saying stay long, develop equities over bonds?
For the time being, yes.
Given the volatility we're seeing in the bond market?
Yes. That may change, in coming months, but for now it is definitely the better place to be, more transparent. You have growth, you have good momentum. There's pent-up demand, so the case is still there for the West. Maybe everybody will do fine next year. We'll see.
Mikio, those gyrations in the bond market, what's being priced in and what do you make of dislocations between asset prices and what's being reflected in the economy?
Well, it's very interesting right now. The bond market, of course, is kind of manipulated by policy or heavily influenced by policy. So whether it offers you negative returns in real terms or even in nominal terms, a lot of investors don't care as long as it's liquid and it has a cash flow, risk-averse investors in particular. So I don't know what that market in particular is pricing in. The interesting thing for me in terms of what the consensus outlook is if you look at earnings, particularly in the developed markets, for the next 12 months, they basically imply a recession. So in the low single digit, the growth rate implied by the current consensus is a low single digit number, which essentially implies close to a recession situation next year in the West. So that is a slowdown that is way too... that kind of slowdown will not happen in my book. So I think that's the most interesting thing. Markets are generally in the bond segment, as well as in the terms of the consensus, are rather cautious, which is actually a good situation to be in because it makes it easier for companies to keep beating estimates.
Right. So what's the path forward for the bond market? What's the path of least resistance?
That's a good question. We wouldn't like to test it, so we are heavily underweight duration. We think that there is a small risk, or maybe more significant than it was 3 months ago, given the most recent numbers. But there is a risk next year that the Fed will be forced to tighten a bit earlier than the market is currently expecting. I think it's still 225 basis point hikes by the Fed. They may have to bring that forward if inflation stays as elevated as we saw in November, and in particular if the employment numbers continue to come in rather strong. There is also political pressure in the U.S. now. A lot of people are concerned about inflation, so that might force the Fed's hand and that is an additional reason why we don't think it's a good idea to have a too big allocation in government bonds.
Do you think central banks have just lost control of what's been going on with the
No,
narrative?
definitely not. I mean,
How are they going
my personal view is that the Fed is doing exactly the right thing. I do think that inflation will ease off, kind of naturally. We just had a freak recession with the COVID thing, and we have freak consequences out of this. This is all the supply chain disruptions. And we are now comparing the worst of last year, year over year, with the best of this year with pent-up demand. I wouldn't extrapolate that. But that is just my view. The market is concerned about inflation. A lot of politicians in the U.S., if you listen into what's going on there, are concerned. Even Biden had to explain himself about inflation. So it is a real, what matters is not what I think. What matters is what the market and also consumers think. And if inflation turns out to be a big issue, then the Fed will have to act to preserve its credibility and so forth. And that may cause volatility in the markets.